Dr. Matt Bosnock from Great Capital is calling for increased rent growth forecasts and increased investor sentiment throughout 2024. Is he off his rocker? What's he thinking? We're going to get into it today. Also reports from John Burns Research and Consulting, as well as the CRE Daily, which is just a great publication, the Fear and Greed Survey for the fourth quarter of 2023, as well as a piece from Newmark. Fourth quarter 23 state of the U.S. capital markets, and then from Fannie Mae 2024 outlook for multifamily affordability. You know, many renters remain cost burden. If you had not heard, also we're going to talk about inflation. What's some of the new data that's coming out? So many good pieces of data today on the Gray Report. So if you're a multifamily investor, kind of active or passive, anywhere on the spectrum, you're in the right spot. Best podcast, best YouTube channel to keep you up to date with all of the most useful information so you can make some really good investing decisions. Again, a lot of good reports today. We're going to be getting into it, talking about multifamily, real estate, commercial real estate, and the macro economy. You're not going to want to miss. Make sure you subscribe to the Great Capital channel. Give us a like, show the support, get the algorithm moving. All right, let's just get into it. Let's do it. Welcome back to The Report, joined once again by Director of Communications and Marketing, producer of The Gray Report, Dr. Matt Bosnock.
Hello.
Matt, we are here today, beautiful, sunny Indianapolis in the Midwest at the Great Capital headquarters. It's a great day to talk about multifamily. Oh, yeah. Things change every single day, every week. Mm-hmm. There's a lot of buyers out there trying to see, is there light at the end of the tunnel? Yeah. There's definitely some shimmers, trying to figure out what it is.
I feel like we're right at the point. Everything's a little clearer. And now, probably tomorrow, some major crisis is going to throw everything up in the air again.
You have to keep your emotions in check because once you think that it's the cake's baked, turns out maybe not so much. I mean, how many times have we thought, talking about capital markets and interest rates, end of last year when the 10-year Treasury had 5%. Okay, it's going to go to 5.5. Rates are going to be so high, and then inflation just dropped out. Mm-hmm. We're like, all right, people were saying the Federal Reserve is going to do 6 rate cuts, which we always thought was a little way too aggressive. But now, that last mile of getting inflation down, which is, in my opinion, the key to kind of unfreeze kind of the commercial real estate market and multifamily, to give investors confidence to go out there and buy deals and do deals. Mm-hmm. It's just a little bit more uncertain. Yeah. And, I've been there multiple times. You're trying to do a deal and the interest rates are running. It's hard to close because, that deal all of a sudden changes and your financing changes so much. But Matt, before we get into any of the initial pieces, and before I ask you about your bold call of kind of reversal of some of these forecasts coming on, what's in the ether? What's the scuttlebutt on the street? What's going on in the multifamily world? What are your thoughts? On this kind of end of February?
A little bit like what I said. Things are clear, just as clear as they were last week.
So not clear or clear?
Well, they're pretty clear now.
What was last week?
Last week was we were talking a little bit about the same sense of like optimism and past the 24. Everyone knows that there's going to be a lot of apartment supply in 2024, and from the multifamily investor's perspective, that you got to survive until 25, or I heard this week do more in 24. How about that's another spin on it. Don't just survive.
The fact that we're operating off of rhymes.
Yeah. If it doesn't rhyme.
But you know what? A lot of money's been made off rhymes, so I'm not going to discount it.
That's good. But really, like I do get the feeling, and we'll get into this when we talk about the PCE inflation. It's like, we're still not there for the economy. There are so many factors that could lead to an economic crisis, and I get a little nervous talking about the economy, but not the multifamily market. So if the underlying economic conditions change, then okay, it may be back to the drawing board. Yeah. But the big thing that I've been reading about this week, whether it's a newsletter or just elsewhere in reports, we are converging on some optimism for apartment demand and for investment demand too in the multifamily market specifically, probably more so than any other sector. There is some optimism about industrial and retail a little bit, but still the most investors are spending money on multifamily, and they intend to do more in 24, much like the rhyme says. So
it makes sense. And again, I've communicated this anecdote from our current fundraise, at Gray Capital. We're raising capital just today at this moment from accredited investors for a project, opportunistic kind of value add deal we have down in southern Indiana, and I can tell you, the sentiment is much more bullish for multifamily. We've been surprised by the reception of the deal and interest from investors, and there's definitely an attitude of, all right, let's get to work, let's get back into it. Whether it's just haven't done a deal in a while, or maybe this deal just looks that compelling. I think it's a great looking deal, but I think that what investors were telling us last year is that it's got to be so good. And they really were communicating, I really want to wait. The waiting seems to be over. Now it's just looking for the good opportunities, and everyone's really excited to find those. All right, Matt, let's just jump. Let's talk about inflation so we can get kind of some of that macro stuff just out of the way.
It's that first tab there. From the Bureau of Economic Analysis comes the Personal Consumption Expenditures Index, and really I think they call it personal outlays or something like that. There's a larger set of numbers that come in each month, and this year I think the headline is less in the document itself than in like the CNBC articles about it, and it is that it's met expectations. It's no higher, no lower than what we expected. So I think that's pretty decent news. I like things that are expected. I don't like things that are unexpected. Even if it's an unexpected, like a good thing, then it's like, I don't know.
And so to be clear, the PCE is what the Federal Reserve looks at. They weigh the PCE more heavily than they do CPI. They look at everything, as they say, but the PCE is the index that they are more focused on rather than CPI. And so when you look at this, let's look at when we go from 3.4 to 3 to 2.7 to 2.6 to 2.4, okay, that seems like we're moving in the right direction. Now, excluding food and energy, 3.6, 3.4, 3.2, 2.9, 2.8. To me, that looks like progress. Now, is it enough progress that the Federal Reserve is going to say, we're going to do a rate cut in March? Absolutely not. Are they going to do one in May? Probably not. But we're making progress, and I think it kind of flies into the face of some of the hotter CPI print that came out last week. And again, the Federal Reserve, Jerome Powell, when he spoke a couple weeks ago, he was really clear. He's like, we don't necessarily even need to see the data get any better. We don't need to see better data. We just need to see data that's more of the same. And while we're so focused on the noise and the Wall Street's so focused on the high frequency information of this data report, that data report, we talked about this last week. The Fed's looking at much longer intervals and periods of time. And so this, I think, is good evidence to say we're not looking at rates doing a major run. Rates will probably come down closer to the end of the year. I don't think that we are taking all rate cuts off the table. I think there's some talk about that, and certainly is possible. But we're making the slow progress down to kind of where the Fed wants it to be, kind of a 2%, kind of neutral rate of inflation. But maybe we don't have to get down to 2%. Jerome Powell said, and the Fed have said, they don't necessarily need to be at 2%. Because the neutral rate, which is, like the rate that basically not restrictive, but it's also not fueling the economy. Maybe it's not 2%. Maybe it's not 2%. But we're going to get there. Maybe sooner rather than later. So I think this is overall, a positive sign for inflation somewhat receding. But I think there's also an understanding that we could still have some decent growth even if inflation is coming in.
It's not balancing it. This isn't like a sunny day after a storm. It's not going to be the opposite. It's just going to be a normal day. It's going to seem probably better than 2023 for the apartment market, because I think that the rent growth is probably going to return to a more historical average. But I think ultimately what I'm really interested in is how multifamily rents, we see the future when it comes to inflation. The way that rent growth is recorded in inflation data lags behind by a year or more. Actually,
more. Well, yeah, more. Maybe 2 years now.
So there was a Moody's analytics report that was just out this past week that I didn't have time to include on here, but I'm talking about it anyways. They were talking about how owners' equivalent of inflation, that actually lags even further behind. Mm-hmm. So it takes, and these owners are responding to questions like, if your home was rented, how much do you think it would rent? And it takes, and
how are they supposed to know?
Exactly. And the aggregate, I guess, evens out. But
who's being interviewed? Who are these people that are answering these questions?
A scientifically chosen market basket of participants.
It's the same people are doing election polls. They're it's like landlines only.
Well, so I'm under the assumption that in the aggregate maybe they arrive on the right data, but what the pattern that Moody's figured out was that maybe they do find that, but they find it after 9 months to a year later, so they are not up to date. The average person, that they respond, they don't know what the exact rent is. It takes them a year to figure it out. So and the net effect of that, I think, is to smooth out any increases and decreases in shelter inflation. And what I'm also thinking about too is how much still increasing home prices are going to act like as a negative counterweight to the improvement that we should see from lower apartment rent growth.
Yeah, that's a good point. Single family homes, they been growing, not at as strong of a clip, but it's the rate of growth is much less.
The ultimate point of that,
and there's maybe some deterioration in the single family home market according to the street.
The ultimate point of the Moody's analytics report was that these shelter measures of inflation need to decrease about 3 percentage points to bring inflation overall to its target level. Now, that's not impossible.
Well, and we know that's already essentially have happened. That needs to happen in the CPI.
And you can't have those countervailing forces, fighting against it the whole time. So if we timed it right, we probably could have if everything was accurate into the moment. But now it's a muddy mess, and I'd like to think there's a better way, but I don't know.
Yeah, it seems like, we've talked about have the CPIs calculated too much, but it's so important because it's what so many decisions are being based off, and where the bond market's going based on people's impression of inflation. Mm-hmm. But it just seems like they just thought too hard about it. They made it a too complicated method than it needs to be. And then I understand you're reducing volatility, but then if it ends up what you're solving for ends up not being reality.
Fannie Mae, which we will discuss in a report here, they use real page numbers for market rent growth.
That's interesting.
I know Fannie Mae's not 100% a government organization, but it seems like
quasi.
They're quasi.
Trust them as far as you can throw them.
Yeah.
All right. So, but another data from the Conference Board looking at the leading economic indicators, not all bright and the rosy picture that some are describing as an economy that's just too good. The leading economic indicators are saying,
it looks
maybe not.
If you look down there, we are definitely in a trough when it comes to these leading economic indicators that the Conference Board has identified. A large portion of these indicators are things like consumer sentiment or business sentiment or CEO sentiment. But that's not to say that there are other things like the goods ordered and things like that.
We're measuring feelings with this.
A portion of its feelings.
But which feelings translate into reality? It's it's the psyche, the psychology, human action. It's all good. But this is it's not the reality. It could be a leading indicator.
You look at
That's why it is leading indicators. But
these leading indicators have run counter to GDP in this Conference Board chart in a way that hasn't been seen at all elsewhere in the chart.
So when we look at this blue line, that's the leading economic indicators. Mm-hmm. This grayish line, that's actual real GDP. It's interesting to seeing the lags between the two, and really not super correlated. There definitely is some, when GDP was spiking, economic indicators up, but there's definitely a little bit of a there's definitely sometimes there's a delay, sometimes it's lagging. It's neither. I mean, if you look at this chart, it's neither leading or lagging, depending on the situation. I mean, if you look at through 2021,
there is definitely correlation before 2021, and then after 2020, the middle of 2021, there is this divergence where GDP keeps going on where it goes, and then the leading economic indicators going.
Yeah, all the business leaders were pretty worried about COVID before it trickled into GDP, but then GDP recovered before business leaders were able to get out of the pandemic bunker and start recovering.
Very good point. Yeah.
So, that all makes sense, and we're driven by media and influence rather than dollars and cents, which obviously there's a correlation there. But that's fascinating that this divergence right now, where look, the GDP is growing. By many indicators, the economy is doing really well. I mean, we can make a list of all the worry cards out there, and it's a long list.
And that's the thing. Is like it's not. This doesn't make me feel good.
Yeah, but I've been doing this long. I'm not saying I've been doing this forever, but I have been doing this long enough now that at any point in time where I've been investing, in business, which is, well over a decade, I could always give you a list of the worry cards and maybe the black swans and you can always, I mean, again, there's the doomsday sayers are always calling for a crash around the corner and the collapse of the US dollar. And it's not like their list of reasons are like all wrong. They're just, overweighting some of them in the probability, and sometimes ignoring a little bit of how just things work sometimes. And that's why we're talking about we'll get into the fear and greed index. It's what's driving, it's the fear and the greed.
I just looking at there's a lot of talk about how the United States is performing well in relation to other countries, but there is a little bit of fear. It's like, all right, it's lonely at the top. Does that mean that we're next? And who knows? But I'd like to be ultimately.
But the United States also, that's nothing new there for us to outperform the rest of the world.
That's right. That's a good point. We are exceptional.
We American exceptionalism. Absolutely. I mean, everyone always convinces me to you got to invest in more emerging markets, and not that there's not good reasons to, and there aren't good emerging markets, but I'm going to keep investing on the betting on the U.S. Again, not that there aren't some good emerging markets, and people are saying, "Oh, you're an idiot," but we continue to outperform. We've got some secret sauce.
And this is
called freedom.
Going a little sidetracking a little bit, but this reshoring that's happening could even maybe perhaps insulate us from crisis abroad. But I think it's not an issue. I will just acknowledge that there are a lot of things I don't have control over in the economy. But when it comes to multifamily, I think that the fear is receding and the greed is.
Well, that's what I like about multifamily. It's a great point. Don't focus on the things you can't control. You can't control the economy. We can't control inflation. We can't control interest rates. But what I like about investing in multifamily is like I can go buy a building and I can fix it up and I can force appreciation.
There's plenty of stuff for you to control.
I can actually control it and be active and do a little bit take control of your own destiny, which is exciting, whether you're doing that or you're finding the group that's going to do that and you're just kind of endorsing the plan. But there's a lot of you can do that in a lot of businesses, just doing your own thing. But yeah, don't worry about the stuff you can't control. It doesn't even if it's like something that's reasonably you could worry about. It doesn't really do. Try to address it if you can, but like there's nothing you can do. I mean, what's the benefit? Let's look, Matt, at this fear and greed index. Now, this is put out by John Burns and CRE Daily. John Burns Research and Consulting and CRE Daily. I guess you could call them a friendly competitor to the Gray Report, Matt. They do. They put out some good stuff, though. You put out
on the daily.
Yeah, it's a little more. That's all they do, though. But give us an overview. What's the difference here between the Q4 2023 and over the next 6 months? What are investors saying about CRE, Matt?
Yeah. So
what does this even mean?
These 900 or so investors got a range of questions and basically they told them, are they Are they intending on buying more? Are assets going to become more valuable? Do you intend to increase your exposure or decrease your exposure? All these, they ask them a bunch of questions. This is 900 or so industry professionals, and then they crunch the numbers, and now we've got these.
I need full disclosure. I did take the survey.
Oh, really? I didn't know that.
I was part of the survey.
Oh, cool.
And not only that, Matt, I just remembered this. Yeah. I was randomly selected, and I won a gift card.
Oh, sweet.
First time that's ever happened.
Awesome.
So thank you, John Burns and CRE Daily. I think I'm thinking of the right survey that I filled out. I'm pretty sure, but yeah, it wasn't anything crazy. It was like a $10, $20 or $40 Amazon gift card.
So was it a simple survey? Did they ask things like, do you plan to?
It was.
Did they ask
a couple months ago? I forget.
Okay. Well, let's assume that they asked you.
Refresh my memory.
In my understanding, they asked you a series of these questions. So overall, their numbers for the fear and greed index. Now, this is not a specific question. I think they just kind of summed up some of this stuff. Overall, 51. So 100 means everyone's greedy. Things are going great because you want to invest.
Full on. Everyone's just frothing at the, so in 2021, Q1 2022, greed would be 100. 0
is fear. Stay inside, lock your doors, don't invest, sell if you can, get out of there.
Yeah.
So right now we're at 51. Normal. Looks pretty normal to me. Definitely not in the 40s. I think that
uncertain.
I think
I would call it.
My interpretation too would be uncertain, because I feel like people would automatically be predisposed to say that they are more optimistic than they're pessimistic.
51 is overall, and you have to that's including office,
Very
which
good.
39 out of 100. That's maybe favorable to office.
Yeah.
So if you strip office out, then you're kind of in the mid 50s.
Yeah.
Multifamily's at 53 out of 100, industrial's at 57 out of 100, retail's at 53, and then office at 39. Yeah. So, it's a little bit above 50.
Mm-hmm. I still think,
office.
I still think that there is an inherent optimism that's missing here. I feel like if you're asking CEOs if they're like, oh yeah, things are going to go great, and we saw a little bit more pronounced optimism in the CBRE numbers. Now I'll get to that too, because I think that we do have a stand-in for some of the information we got from CBRE. Okay. So that's the third question. But I'll get to the second one, which is, do you intend your current strategy? Do you intend to have you been at this moment decreasing your exposure to CRE, increasing your exposure, or not changing anything? And overall, 53 for commercial real estate. All the sectors. Multifamily was at 54, so a little bit more. Industrial was the strongest at 59, retail 53, office 43. These are very similar to the fear and greed index. But the one I'm really looking at right now is, what do you expect to do in 6 months?
Yeah, this is interesting.
And so overall there is 64, a market improvement from the 51 or the 53 of current. Now, multifamily is at 72, industrial 70, retail 69, office 45. Most people, despite the fear and greed index being slightly lower for multifamily than industrial, more people intend to buy multifamily properties. That's the upshot to all of this, I think.
And I think that's just another piece of another data point for the argument that we've been saying, Matt, is a belief that there's a price floor in multifamily. Valuations have been coming down, but there's so much dry powder on the sidelines, around $250 billion, depending, plus or minus, depending on who you talk to. That's ready to jump in and do multifamily deals. And this data point kind of confirms that there is pent up demand for acquiring multifamily assets. And again, getting back, this is a little bit of a data point, getting back to the anecdote of what we're seeing in our current capital raise, that if you're a credit investor, you can learn all about it, graycap.net. There is definitely some, there is interest for multifamily deals right now. People want to get in because the prices are going to get run up again. I'm not into an unsustainable level in the short term, but the deals, the wealth creating, potentially life changing opportunities, the ones that in 15 years from now, we'll be telling about. You remember when we got that deal at a discount? Those are going to come now, and they don't exist for forever.
Yeah,
especially when there's this much interest.
And I think it does make sense, because there was a time that demand was penting up or whatever. It was a lot less activity last year, and I think that did kind of things clicked in people's heads. Like, I'm sick of not that they're sick of sitting on the sidelines, but that they are just looking for opportunities. I think there are business models out there for investors too, not just like brokers or syndicators, where they've got to put their money somewhere, and and the timer's running out, and that's kind of increasing the demand from investors, and perhaps maybe lowering their threshold to invest.
Yeah, but also in this last. This last quadrant, access to CRE capital, and then it kind of leads into a kind of another topic, that sort of negates my previous comment of like a lot of people are ready to go. Access to capital. Now, this isn't necessarily debt or equity. They're just wrapping all capital into a bundle.
That's what my big question was there.
I assume it's just it's equity and debt. Pretty low. 20. It's hard to access capital. 25 overall out of 100. 23 for multifamily, which is interesting because with the agencies, the financing is there. Now, if you're talking to developers, that would probably be the case. 31 for industrial, 29 for retail, office 17. No one wants to lend on office. The other factor I just think it's worth mentioning is, while like I mentioned, there is pent up demand, there's also a lot of investors who have been burned recently, or are actively being burned by a lot of deals that aren't doing so hot right now. I mean, I have had multiple conversations the last day or two of people being like, I'd love to do this deal, but like I'm just not liquid because I just had to meet another capital call. And I've got this one investment over here that I'm writing it off. It's going to zero. It's gone to zero. And that's the reality that a lot of folks are facing. We don't necessarily see it every day, Matt, because our deals we're not dealing with that with our deals. But I'm hearing it more and more when I'm talking to investors who, LPs that are investing with a lot of other groups that they're having bad experiences. And that's going to leave a sour taste in a lot of people's mouth. And they may decide they're never going to invest in multifamily again, or they're just going to take a big pause for a while. And it's unfortunate because, as those folks are getting out of the market, is the right time to get into the market. And it takes, a lot of emotional fortitude to say, I've just gotten smacked up and down. I'm going to do it again. Okay, I picked the wrong horse, or we used the wrong financing, or we paid too much on that. But the thought of investing in multifamily wasn't wrong. I just got caught between a rock and a hard place, and I was playing musical chairs with my financing strategy when the music stopped. Doesn't mean necessarily that the game sucks or it's not a great investment class and thesis over the next 10 years. It's just there's risk in everything, and but also how you execute matters. And I think people got really comfortable with always winning and always doing really well and making huge returns. And it seemed like there was I would hear people say like there's basically no risk in this. No one loses. And people who've been around, would remind them like, well, you don't have to go back too far to see people lose. And I just wait for history to repeat itself.
Well, and I also think like, and we've discussed this before, this idea that like, these young people that have never been and seen like a housing crash before, they only know the good market, and then they don't know how to deal in the real world. I think everyone's adapting to the same thing at the same time. There's always going to be recency bias, but you always have to know when something's going to be too good to be true. The good times, they sometimes end, but they come back, and you have to be patient.
You can't have the good without the bad. Like that's just the reality. You can't have the ups without the downs. Everything closes to equaling itself out, and you just hope that you keep raising your median and the average, and you keep pushing forward at the end of the day.
But what you just read here about all of these low expectations for access to capital in this fear and greed survey, it is worth putting it in just like simple terms. Like, people think that it's going to be twice as hard to get capital this year than maybe a typical year. I don't think that is as true according to our experience raising. Maybe we've just got this amazing deal, but it did not seem to be that way. I think that
if you have like the average deal in the market of just like what a broker's sending to you, there's no interest in that deal. Well, like a lot of the deals that we've looked at that we didn't pursue, there was probably no interest in that deal.
But I wonder too if there really is like a direct a portion of this answer is debt too, because that makes sense.
Yeah, it's debt, but also there was a huge, this survey was taken in Q4 23. That's when the shift started happening at the end of Q4 2023. So depending on when the survey was taken,
it was taken around, I think, January 8th to 22nd. So, but it's still like,
so in 24.
Yeah,
so Q1 and 24.
I know. That's why I did have a little bit of a big question mark about
whatever.
Timing.
Well, people hadn't done any deals yet, so they didn't.
No. I do think that I was very surprised at that at the low numbers for this access, and it must be related to interest rates. The only way I could understand it, because if there really is so little interest, we would see it in the amount of less dry powder. We would see it in the kind of lower investor attention, and that doesn't seem to be happening.
Well, I mean, last year there was a lot. There was definitely a drop. There was definitely last year. There was not a lot of capital being raised. It was tough. I don't know. I don't know if I believe. I know. I mentioned the $250 billion of dry powder. I don't really believe that. I just don't have confidence in that number. Yeah. I think that there's a lot of dry powder out there, but the number hasn't really changed much. And just knowing that reporting is so opaque, and it's kind of whatever people say. And I don't believe it. I think it's BS.
Yeah, well, and there's always this chunk. I think there's most of that dry powder is never going to get touched. It's always going to stay dry, or maybe it never was there. I don't know, but I did read.
Fugazi, Matt.
I know. As part of some of the research that I was doing for this week's newsletter, I did read in places that said the dry powder in 2023 decreased slightly, maybe around 5 to 8%. But that's
because they had to change it a little bit.
Yeah, and so ultimately, though,
they had to maintain some credibility.
The only way that response about making it hard to get capital, the only way that makes sense to me is if they were thinking about 23. I think 24 is going to be easier to get capital than last year.
People are seeing, people were buying 2-year bonds 2 years ago, 2-year treasuries. People were buying. I've been buying 6-month treasuries. They're buying short-term treasuries that are maturing, and they're like, "What am I? I've got to put this cash somewhere. Do I buy more bonds? Do I throw in a money market? Okay, well, the money market, it's great. It's paying 5.25% right now. It's not going to pay that forever, and 5% isn't going to get me where I want to be on my investment goals and journey. If I need to be, compounding at 10%, 8 to 12%, 5.25 doesn't get you there. So you need to get into some risk assets. Excuse me, at some point. And a lot of folks, the stock market's frothy. Yeah. It is frothy right now. I mean, the PE ratios are high. It's being mostly led by, NVIDIA and similar groups. And so it's not like a complete broad-based rally. I think it's maybe spreading out a little bit, but the stock market doesn't seem cheap, and a lot of investors who are real estate investors don't like investing in the stock market. Yeah. So what are you going to do with your capital? And your financial goals are starting to kind of go at the wayside if you don't get into any assets that are going to attribute you some growth. And then if you've got, again, a little bit of fortitude and a little bit of foresight, you say, okay, well, prices are down. And they've got on this survey, Matt, they have kind of an opinion of where prices are, which is a little bit not as kind of deep as what we're seeing in reality. Yeah. Changes in commercial real estate asset values by sector: multifamily down 12%, industrial down 4%, retail down 3%, and office down 20-25. Well, Matt, we've seen sales of office buildings that have been selling for, for half or less of their previous value. We're buying a multifamily property that's basically a 30% discount from the market peak. So I don't know, am I missing something here?
Also, what's interesting here is this 3Q 2023, that little orange diamond.
So it's gone up?
Those. So yeah.
What does that mean? So prices have come up, or this is 12%?
When they asked people in October, people thought that prices were down by 17. And now they think that prices went down by 12 only. So people's opinion of the value loss in multifamily properties is less now than it was in October.
Interesting. You could draw a lot of conclusions more on like the psychology of who's taking the survey,
and maybe it's widening because in October it was around 700 people. Now it's around 900 people. I don't know if all those people added were a little bit more optimistic. I do think though it's a sentiment thing. Things feel like a little bit better. So maybe you're gonna feel like the values didn't go down. They're not jumping on their spreadsheets. They're just giving a percentage.
And also, are you thinking about your own book, or are you thinking about like the other market of assets you're going to buy? Because if you're thinking about your own book, you're like, oh, no mark to market, 5% maybe, but we've increased NOI, so it's fine. Yeah. Versus, if you're trying to buy something, it's like, hey, the market's down 20 to 40%. Mm-hmm. That's where that's the price.
Yeah.
It's probably somewhere in the middle, man.
Yeah, it always is.
Investors believe that multifamily and office values have fallen further to fall in 2024. It's interesting, but not that much. I mean, 2% for multifamily. Mm-hmm. I mean, that's basically almost a rounding error. Office. I mean, people just. I mean, there's just no end in sight for the bloodbath of office. And if you look at the lease maturities over time, they're just going to be one after the other. Although, I don't know. I am not an office investor, Matt, but I am. I think that people will still go into offices, and like work still has to be done, and like maybe we have too many office buildings. Maybe.
But then there's something that like when I hear about Blackstone like jumping in the office sector or something like that.
I think that again, it's not us, Matt. So definitely not talking.
But I was like, but
I think somebody's going to be buying up some good office properties and fixing them up. Buying something that like has not as much physical obsolescence, and making it a really cool office building. Mm-hmm. The office that we're in, if you're paying attention, like where the heck are these guys? The Gray Capital. This is the Gray Capital office. You can kind of see just a portion of it right behind us. Yep, that's a shuffleboard table. But this is an old repurposed old corrugated box factory. And that was shelled out. Nothing was here. Homeless people were living in it. They converted to these awesome offices and a climbing gym. And
during the pandemic,
we got a decent deal, during the pandemic, and they're almost fully leased up. It's doing well.
It's harder to park in the parking lot.
The place is slammed all the time. People are in the offices, so I know this is the one little case, but I'm just saying there's definitely an opportunity for some enterprising entrepreneurs in the office space. And so if you got a good idea, and it's not converting offices to apartments. I'm not saying that's always a bad idea, just it often isn't a good idea. Mm-hmm. Any other strategy about buying some offices? Let us know in the comments. I'd be curious what you all are thinking. You can say the housing if you want, but just that's way easier said than done, as we've learned. So we'll keep anything else on this report, Matt, you'd like to touch on before we move on?
Not necessarily, just that things do seem like they're slightly improving, and if you look at what people's plans are moving forward, they're kind of forward-looking assessments on what their intent is. It's very clear that people are optimistic, and the assessments are similar for sure.
Yeah. All right. Well, okay. Newmark Q4 2023 state of U.S. capital markets. Matt, let's see where the sentiment meets the reality.
So I'm only going to go over the headlines of this 73-page report.
Go over the headlines. You know where you can go to get the full reports?
Go to grayreport.com.
Grayreport.com. You can sign up for the Gray Report newsletter, which you can find at grayreport.com.
GrayCapitalLLC.com/newsletter.
Wherever you want to go. Check us out. Okay, Matt, tell us the headlines. What's going on?
All right. So this covers capital markets last year for commercial real estate, and it's a pretty dim picture. Well, it's a clear picture of a dark market in 2023. Top line numbers, they say investment sales declined 53% year over year in 2023, and 33% compared with 2017 to 2019 average. And it's not just declining sales in office. It's a lot of sectors. And so it's not much a surprise, but again, this is a crucial context to understand the current CRE investment market. Last year, a solid 1/3 less active than the pre-pandemic years. And debt origination was down by 44%. And also, importantly, they estimate that $670 billion of debt will mature between 2024 and 2026, and that debt maturing is potentially troubled. So we're not necessarily out of the woods yet when it comes to potential interest rate driven distress. However, it hasn't emerged in the kind of crisis that that was in some of the headlines. Let's just say it that way.
Well, in some of our headlines, Matt. Yeah. But on that note, and I think what is with the cans being kicked down the road. And so the challenge is, especially, if interest rates don't come down as soon as some folks would like, the challenge is we're creating additional concentrations because all these deals that were set to expire starting in October of 2023, the can's been kicked down the road.
Doesn't get rid of it. Yeah.
It doesn't get rid of it. So let's give you another 6 months, let's give you another year. So, we're talking at the end of 2024, through early 2025, we still could have some of these, issues that popping up of these maturities coming due and folks unable to refinance out. So it'll be interesting how long the banks will keep kind of playing along with this extend and pretend. The problem is certainly there. It's just being kind of swept under the rug and kind of pushed down.
Now that is almost like the only factor if you're comparing the early 2023 with early 2024, that's one of like the most troublesome aspects of commercial real estate. A lot of other things seem like maybe they're doing better than last year.
Other than the supply coming online.
Yeah, other than the supply coming online is, especially for multifamily, that's going to be lower rent growth. But if it's met with demand, then...
And we're seeing actually some incredibly strong demand.
And I just want to say this, from that pessimistic perspective, we did just finish a year where CRE investment sales went down significantly, debt origination down also a large amount, dry powders down slightly, cap rates are too high. That's something that they also note here. Cap rates are too high relative to the cost of debt capital, possibly accepting office REITs. That's what they say there. So like this is a recipe for a CRE downturn if you look at it in a certain way. But I think that we have a fairly stable economy. I'm still worried, but there is no.
But there's already kind of been, now if you believe that values are only down 12%, maybe not. I mean that's still a correction. But if values are down 30%, more than 20%, up to 40%, I think 20 to 30 is what people are saying. Kind of maybe 15 to 35, somewhere in that range. That's certainly, I don't know what you call a downturn, but hasn't it already happened?
Yeah, I think,
and again, that going back to the loan maturities piece, a lot of people are just like, well, that never ended up happening. But it's like, well, values are down 30%. I don't know, but so something happened.
Yeah, and I think that's really worth saying. Like a 30% cut to values, even just a 20% reduction of values is really significant. And I think we went over this a couple weeks ago. The only real reason why people weren't crying about it essentially is that they went up so much the previous year or two before. But that doesn't take away the significant decrease.
Well, it doesn't feel as bad if you bought in 2019 and you saw the value go up and now it's just down. You're still a little bit up from 2019. But if you bought at 2021 or 2022 at peak pricing, that feels a little bit worse, especially if you have to, realize that loss because of a capital event and a loan maturity that's coming up. Even if you bought at the top of the market, but if you put fixed rate debt on it, well, you're still not doing as well as you had hoped because you're probably not getting the rent growth you thought, but you're probably not losing any money. You're probably still cash flowing.
Yeah.
So, I mean, assuming that you bought on positive leverage, and again, all last year is why we're saying it's like you got to go in. If you're going to buy, you got to have some positive leverage. You got to be cash flowing. You have to have. You cannot in this type of environment. You can't over speculate. You can't just say, well, we're just going to grow our way out of it because you maybe can over time, but if you need that to happen over a compressed period of time, that's a big question. And there are maybe factors that are beyond your control that could put yourself in your investors in a bad situation, which is exactly what's happened. Versus,
I remember talking about that earlier. It's like if you're planning on interest rates as this core business plan, if interest rates going down is what you're banking on, then it's like double the pain is coming up.
It's interest rates, but it's also this idea that again, it's not incorrect, but it's the idea of don't worry about that. We're going to grow out of it. Yeah, we've got negative cash flow year one, but we're going to raise rents and we're going to reduce expenses. And in Excel, I can see where we see cash flow. Like that's a pipe dream that, pipe dreams can come true, but they don't necessarily come true, and very rarely the way that you laid it out in your model. And so again, this, like, the way we look at deals is like they have to work today. If whatever we do doesn't translate to any actual growth, we're not losing money. It's not going to look good, but we want to be cash flow positive and be able to sustain the investment and preserve principal. Because again, it's not super complicated. Warren Buffett's, rule number 1 and number 2, you don't lose money. And then the second rule is you follow the first rule. And so don't lose money. And if you buy your deal to where it's going to be cash flowing almost regardless of what happens, and if you miss your projections, you're going to be in a much more secure position to ride out any storm, because then you can, if you have a long-term outlook, you can allow 5 to 7 years of growth. Because maybe you don't get your growth in the first 2 years. You may be disappointed and your investors may be a little bit disappointed, but if you've done enough of these deals, that the first couple of years can be a little rocky. I mean, in normal times, things don't always go as planned, but it's called seasoning. It typically takes 2 to 3 years to season an asset. And that's not as quick as people want, and it's not as quick as it shows up in an underwriting model or pro forma. But if you're giving yourself only 3 years on your debt,
well, it's hard to think. It's so many complicated things happening. Like, for instance, let's say you go in there, you renovate something, you renovate that whole apartment building. It's not like instantly new people are going to move in and pay those higher rents. It takes marketing. You've got to get those meetings with your leasing agent. You've got to get them to sign. And
what if people don't move out? What
if they don't move out?
What if they don't move out?
It
happens all the time. I mean, talk to owners in Atlanta right now, in Fulton County. It's a disaster down there right now. The delinquency rates are sky high. People decide that they don't want to pay rent. There's laws to where you can't evict some. One, the judges are giving people more time and more time. This whole eviction moratorium, which I sort of forgot about, but like they took very seriously and is still going on in some ways. And then you need to have like an actual sheriff be present at the eviction. There's not enough sheriffs. Like, they just physically aren't enough. And so it's
then they're moving into those mansions and partying all the time, renting an Airbnb for 1 week, and suddenly it's 2 months and they're not leaving.
Just never going to leave. And so lack of a better term, shit happens, man. And not to mention, prices can go all over the place. Things can come, over budget, or just if you're an out-of-state investor, if you don't really understand the demographics, like you said, man, you think the whole other demographic is going to move in here. Well, maybe, but you could get it wrong. It's just because you're adjacent to something, it's called being on the wrong side of the tracks. Like, you don't want to necessarily be the first pioneer. As they say, the first, what happens to pioneers, they get a bunch of arrows in the back. Not always. Sometimes you can get all the way on the Oregon Trail and find prosperity, but
just a greenhorn here.
It can be tough. Okay, Matt. Anything else from? Do we hit the highlights?
I just wanted to really give that bird's eye view of the market, and it's worth just a really reminder of what we've been through, and it makes 2024, I think, look a little bit better.
Well, as a bird flies, Matt, let's keep moving. Now we've got a piece from Fannie Mae, I believe. Is this right? Now Fannie Mae, a lot on affordability. Should I go up to the top of this?
Let's go to the first. For sure, because that's where the discussion was flowing. This is a little bit of a follow up on our discussion about affordability last week. This Fannie Mae report covers the exact same topic. They probably watched it and was like, all right, let's publish this, but. That's just to say. What does this add, though, and why am I covering it? I think it really does add a helpful illustration of rent payments and a breakdown that we didn't see last week when we talked about sources from like the Harvard Joint Center for Housing Studies. And you can see here that, rent payments, now this is looking at the share of rent payments made by the end of the month, kind of like delinquencies. The rent payments went down during the pandemic and clearly were worth tracking. I remember when we talked about it every week. But from April 20.
Yeah, the NMHC
payment
calculator. I wish they would.
I know they definitely dropped it. They don't. It's no longer going. But just to kind of describe the narrative here of these trends from April 2020 through November 2021, just over 86% of Class C renters were able to pay their rent by the end of the month, compared to 89% of all renters. While not as stark, Class B saw some erosion in payments too, getting to 93, down from 95.5. So the real change, though, looking at this graph, the real change here is in the Class C properties. So renters of Class C properties had a harder time making payments on time during the pandemic than Class B renters. The difference is that Class C properties, their payments have risen just about the halfway between where they used to be pre-pandemic and where they are now. Whereas Class B and Class A properties, their payments are in the same, they're pandemic levels. So
yeah, they're in the same range.
And when I'm talking about shifts, we are really only talking about like 2.5% to 3% differences in rent payments. But regardless, it is, it shows at least, I think, a slight improvement in rent payments, and I know that you can look at October, November, and December, which is the last 3 months here indicated, and you can see lower rent payments there. But this is a very volatile chart, anyways. And the general trend is improving.
I was just going to say that the general trend is definitely improving, and that coincides with two things. One, wages increasing, especially in this quartile, kind of the bottom quartile, or the bottom half, I guess. And then also, rent growth has basically paused, or rents have declined. So affordability.
I'm glad you mentioned that. Because they've got some great. The next charts are actually way more useful, these next two. So the first one is for Class B properties, and we'll get to Class C. But Class B, they have lines here. They show the wage growth for production non-supervisory workers. They're using that as a corollary for Class B renters, and then they're looking at Class B rent growth, and then the CPI. So it's clear that where was it? There was a clear divergence in about December of 2022, where rent growth became lower than wage growth, and it continued to get lower and lower all the way. That happened throughout the entire year of 2023 up until now, even and still now. So at this point, wage growth is at 4.3, rent growth is at 1.2, and CPI, which is basically inflation, is at 3.4, basically in the middle. So Class B renters have had a year of improving situation, of improving apartment affordability.
And most likely that dynamic will play out through the rest of 2024. Wages will continue to increase, and rents may rise, but kind of nominally, just a little bit. Really market dependent.
Yeah, and what it does show there too is a significant cushion. Rent growth could come up, 2%, and it would still be under wage growth for Class B properties. Yeah. Now it's a supply issue.
You're catching up off of when it peaked at 18%, but that's neither. That's then. Now.
So
Class C affordability is not improving though, man.
Well.
That's what this headline says.
That headline is inaccurate. However, you could change it a little bit, and it would still be, kind of true. It has not been improving. It is only just now improving. So whereas Class B renters had a whole year of improving rent affordability, the intersection really only happened in October of last year. So it was only like 3 or 4 months for Class C renters. It was only in October where rent growth finally was was lower than wage growth.
Yeah. So. Yeah, it makes sense why delinquency is up.
Yeah, and if you think about it, though, I mean, the trend, if you continue this trend for Class C renters, though, apartment affordability should increase. There is the rent growth for Class C properties; it is still trending down, and it may continue to do so. I don't know, I don't know for sure, but. It doesn't look. It's not like things are getting worse, at least in the way that chart indicates. It just means that Class C renters have not had the breathing room that Class B renters have.
Yeah. And it looks like we just missed data in 2020 just everyone worked from home.
Yeah. Well, so I didn't really. I wasn't really looking at.
I know. I just was more. I was just more focused on the data.
There are so many data. If you look into the St. Louis Fred website, so many data, so many charts that you pull up have that missing block of time in the pandemic. It's like, well, all right.
Well, and I mean, the Federal Reserve. I mean, they mentioned the last Jerome Powell at the last press conference is they were using different sets of data, more private industry, for private market, higher frequency data, novel data. They reverted back to more using their historic data sets. You have to wonder, again, if maybe some of the private market stuff is a little bit better to go off of.
Because the government people wouldn't leave their houses during the pandemic, couldn't they? They couldn't get the survey takers
if you don't
because they were under lockdown.
Know anything else about like how well the government's working for you.
That's what I think happened on the day-to-day.
How much of the economy do we want the government to be in charge of?
Yeah.
Just look at what they were. What do you need much more evidence than that? Not saying that all our private corporations are good, far from it, but at least they show up.
Sweet job if you had it though.
Sweet job if you had it. Eviction filings relative to the historic average.
There's another really interesting chart where it actually does show some slight improvement if you're kind of looking at it in the right way. Eviction filings have returned to the levels that they were pre-pandemic, and from basically March of 2023.
So 100% is back to normal.
I think so. That's where they're probably set their mean or whatever it is here.
Okay.
I'm not completely sure there, but so yes, this is current month evictions relative to average, and so I guess they set their average.
Again, it's crazy because everyone. You remember it was reported on so much, but all this talk of the eviction tsunami during the pandemic, and there's going to be wave after wave of evictions, and that never happened. But if you looked at the data, there was a lot more evictions before the pandemic than they were happening during the pandemic because of so-called eviction moratoriums, and that's what's happening in Atlanta. The eviction moratorium has just been stretched out, and we're not back. But again, this is not this is more of like a reflection of like policy than I think than the reality.
That's
of
what I wonder too.
To
Yeah. So
why are properties going into foreclosure and people can't pay their mortgage?
Yeah. So March 23rd, or in March of 2023, this is really the only time where evictions exceeded the average, and actually since that month, evictions have gone down, and now they're at almost close to 88% compared to the average. So it's lower than it was now. The fact that it's going down just at the same time as you would think eviction moratoriums themselves get wound down, I think that's a positive sign, because if it was about stable, then maybe you would think, okay, the reason why it's stable is because moratoriums are still maybe in fact, and it's like they're just like in suspended animation, and policy isn't moving. But I think it's a good trend to look at, and I wonder why it is still now. The only thing I can think of is
especially when you look at that affordability is low, and that people have a hard time paying rents and payments are down. You think that eviction
because and this Fannie Mae article is definitely written.
This is from the eviction lab at Princeton.
Well, so this Fannie Mae article itself is written with a general argument that affordability it continues to be a challenge for renters. There's no other way to put it. This is an article where it says it's from the perspective of the renters, but you could flip it and say from the investor's perspective, rent growth is good for us.
I'm just saying, I remember watching this data from the eviction lab at Princeton during the pandemic, and it did not strike me as high quality. And it struck me as very...
they set it up and they were expecting the wave of evictions.
They had kind of a predetermined outcome of what they were solving for.
Got all this?
Yeah, there's definitely an agenda, which is, evictions bad, landlords bad, and evictions are bad. But basically they were saying that it was worse than it was at the time. So I'm sure it's fine. But
and they do note it to Fannie Mae's credit. They note that evictions have been trending downward, and I think that that's a good sign no matter where you are. You don't want people to get kicked out, and I'm not denying that affordability is a struggle for a lot of people. It doesn't mean it's not just a net benefit at all.
It is. No, I mean, man, we've brought on a new team member recently to focus on working with residents who are having a hard time, that are falling behind, to kind of be not really like a counselor or a financial advisor. They're not a financial advisor, but to check in, what's going on, how can we help? These are the resources that are available. Opening a line of communication that someone other than the property manager, because the property managers have so much stuff going on. And then especially if there is rent that is past due, having a kind of a different face that's handling that. So it's not, they're not a debt collector, but they're trying to collect our rent, but also like, hey, what's going on? Because an eviction is, we'd much rather you get on your feet and be able to pay rent than us evicting you, because certainly no money coming in, and the judges may kick the can down the road, and you may have months of back rent, and it's not a good scenario.
It's really fun. It's really interesting how, reading these discussions about the horror stories. This is the people that rent the mansion and don't move out, or rent the guy's back house, and
or the room, or the room.
And what I always think about is the common discussion. Talking to property managers with experience, and even really you and Jay, is like, a lot of times it's, you just get cash for keys. It's like, I just need you out.
Oh yeah.
I don't want to pursue this lengthy eviction process. I don't want this problem anymore. I just want to get back to a paying renter that can come in.
Especially if you're highly occupied. It's like, look, people want this unit. We want to get in, fix it up, and rent it. Just leave. Just give us the keys. No eviction will go on your record. It's not going to hit your credit. And maybe we'll even pay you to do so. So
I was surprised that there's a cash for keys. It's like, it doesn't rhyme, but it's enough of a phrase that I've heard before where it's like, okay, that's, some people do that, and it's like, they don't bat an eye, and it's the reason is because I don't think people like fighting about this. Much rather try to figure something out.
No, you want to try to find a good solution for everybody. No, you don't want to put anybody out. Okay, rent growth, Matt. As you said, they're looking at Real Page, looking at Moody's, looking at CoStar, CBRE. I don't see the Gray Capital, Matt Bossnagel average. But you made some comments, and you heard me on the intro of today's show. You made a bold call. I want to hear more about it.
So I don't even need, the glory of this is I don't even need to make the call, because the call's right here. Everyone is seeing improving rent growth, no matter if you're CBRE, CoStar, Moody's, or Real Page. Don't know why they don't have. I guess you already Matrix or Marcus and Millichip. They didn't have time to put them in there, but they're all improving. All of these lines. Basically on 2025. Now I will have a caveat here. When they gathered this, CoStar rent growth, their projections for 2024 was 3.8. Their current projections for 2024 is 2.5, because they listened to the Gray report and they heard what I predicted, which was 2.5. That's fine. The average then is for 2024, the average of all of these, I've got to look at my notes here because I had to recalculate, is 2.125. So
that's down. So it's not. So the call was the call is incorrect. So you're actually calling for less rent growth this year.
No. That's just what everyone else says. I still say 2.5. I still say 2.5. I can't change my own thing. If I'm wrong, I'm wrong.
If you're data dependent, Matt, you got to be open.
But that's that's the average of the predictions for 2024. The real story of this chart, though, is how much things are improving from a rent growth perspective in 2025 and 2026. For 25, it is rent growth is all the way up to 2.875, and for 2026 they close in really on 3.2, and they stay in that range for 27, 28. I think that as you further go away from the current year, you just go to the historical. They all want to put 3.5, whatever the historical norm for rent growth is. But it is really interesting how quickly the jump is in rent growth from 2024 to 2025 for all of these sources.
And do you think that is just a reversion of the mean, and they're assuming that supply is going to just really come down to a trickle, and we're just going to get back to those historical levels? Do you think that there's much more scientific thought or statistical analysis beyond, a reversion to the mean, and the historic average is 3%, and they're just saying they're just sticking it at 3%. Is there anything more to it than that?
No, that's sad. That's why I try to say, okay.
No, because that is exactly what happened.
Well, if it was reversion to the mean, I would think that I'd see something like a more gradual, like the same amount of increase happens in 24, 25, and 26. But it seems like we get this first. It seems like
these are pretty straight lines to 3%.
I mean, it's maybe like, I don't know. I just see the most as you go from from the end of 24 to the end of 25. That may be where the sharpest rent growth is. However, if we are really dealing with supply, and what our discussions of the real cut in supply may happen in the middle of 2025, and then the rent growth could be like from June 25 to June 26. Maybe that's the window. But
I think in second half of 2025 to 2026, I could see us being in the 4 to 5% range in some markets.
Yeah. Another important thing to note, especially especially given that we have just finished talking about a 2023 with rent growth stagnating, and and a fear and greed index where people think the valuations could be decreasing, and there's this atmosphere where it wasn't great last year. All of these projections are for positive rent growth. It's almost like, obviously there is going to be positive rent growth, but you couldn't say that for 2023. So we are converging on optimism, and that was the newsletter title today. But I do think that multiple sources are
normalcy, a little bit of, but whatever normal, the new normal. Remember that?
These challenging times. I heard an ad.
I hope you are safe, happy, and healthy. I hope you are well. Hope you. How did you, Matt? Let me ask you this.
Yeah.
How did you start all of your emails in 2020?
I don't know, but I quickly zeroed in on challenging times as my.
During these challenging times, hope the family's healthy and happy. Everyone's doing okay. You guys are all healthy.
New normal
it was like every email, every time you reached out to somebody, it was like it was like in a quiet voice.
Yeah.
You're all doing all right. Are you guys all doing okay?
Yeah.
Okay. We've got an opportunity. I don't know if you've been interested. I'm going to sell you something. Is everyone healthy?
Yeah.
It was interesting times.
We understand that a lot of people are going through a lot of difficulties in these challenging times. I heard an ad just yesterday. Still said these challenging times. It's hard to.
I love when the ads they just leave them on from one. They don't change it, and so it goes from one crisis to the next. Of where it's like the United States economy going through incredible challenging times, and it's like, and then you hear it, and it's like, no, I'm like the economy's doing great. What are they talking about?
Yeah.
And then it's like they finally, it kind of takes a dip, and I'm like, okay, now the broken clock is now reading the correct time. Once again.
That's a good. There's always room for doom.
There's always. It's definitely more exciting. Yeah. That's last week, Matt, we were dealing with a Russian nuclear weapon in space.
Yeah.
And I'm like, you don't think the Russians putting nukes in space for the longest time? There's always something to be afraid about. Again, you can't control it. Why are you worried about it?
And I still
EMP.
think. Do you remember 2 years ago, or maybe it was 3 years ago, Evergrande, and I'm still waiting for that to ripple through.
That's been still ripple. They're still rippling, and but it's not. China's not doing too hot. Not that I'm a China expert, but it's definitely not doing great. But as we digress, Matt.
Moving from optimism to optimism for the multifamily market is CBRE was one of these sources that Fannie Mae had when they collected all this rent growth stuff that showed positive rent growth. And just to kind of double down on their data here, CBRE themselves had a little short article that's a complement, really follows nicely from that Fannie Mae data.
Can I ask you, Matt, multifamily market travails not likely to last. Give me your opinion of that headline.
People don't like travails.
I don't like travails.
I had to check if I was spelling it right, and I've read my fair share of 19th century American literature. But
Matt, you are a doctor of literature, I believe. You have some higher education.
I will identify that as an antiquated, archaic term.
Anyway, I know that everyone here is for the color and the commentary of the headlines, but what is so good about this report that we can get past this headline?
if you scroll down, it's got a really nice chart where they show that rent growth is expected to grow. And really the point of this is, hey, you should be optimistic about CBRE, or I'm sorry, about multifamily. You should be optimistic about CBRE because they are also, they also have a little bit more rose-colored glasses than the Bigger Pockets article that we talked about 2 weeks ago.
Yeah.
That was pessimistic, that said multifamily crash is likely to continue in 2024. They don't think so at CBRE. They seemingly don't think so, at RealPage or CoStar or Moody's, and according to the Fear and Greed survey, they don't think so either.
Yeah.
All of these sources, whether they're coming from the 900 or so respondents that are saying, most of us, 72% are going to acquire more, whether it's those respondents, whether it's the experts at the heads of these companies that are putting together their projections for rent growth, which are quite positive. A lot of different people are saying good things about the market, and hopefully that'll lead not too much competition. Enough people will be worried about the multifamily market to keep the prices low, but I think a lot of people are probably get ready to buy.
I think it's going to be a little bit of combination of both. I think that there's going to be some people who are going to be very slow to get back into the market. Again, like we talked about, they've been burned recently, or they're just still want to stay on the sidelines until the all clear. But then there's other folks that are like us that are starting to see opportunities and are making some strategic and tactical moves to deploy into the market. Yeah. I see very much of kind of what our strategy has been is, we've never been really officially, pencils down and out of the market. We're looking for deals, but we had a pretty good understanding of where the market, because you never know what the market's going to do, but just doing this every week and studying it, being a full-time job and all that, good sense that there will be better buying opportunities in the future, but also, hey, we're open to any opportunity that comes up. Yeah. But then making a decision to, once we found an opportunity that looked really good, and looking at kind of where we are potentially in the cycle, but still seeing that there's a fog of war, confusion in the market, not sure. There's a great time, I think, to get in if you've got conviction, which we do, especially on this deal that we're working on right now, and going forward throughout the rest of the year, knowing that prices are down, knowing that sellers are starting to capitulate, and knowing that capital markets are going to be slowly improving over the next period of year or two.
I think it is a highlight to think, in that Fear and Greed survey, they thought that multifamily values decreased 12% in the past, and then we're going to look forward to 2% in the future. Yeah. If I was an investor, I'd be willing to take that little 2% if we saw 12.
Yeah, and because the 2%, if those numbers are real, which probably not, but if the values have declined 12%, and you're like, well, they might go down another 2%. Yeah. But by the time they've gone down another 2%, everyone gets back in the market.
Now that assumes
it's too late.
That's assuming that the values will quickly come and recapture that.
And it's also assuming that the prices don't drop 20% after that. I'd say the prices have already dropped more than 12. I think they're in the 15 to 30-ish% range. But part of our kind of thesis is values are down. Yeah, we don't know if we're in the trough or not.
Well, it's like that what you were talking about, CPI Capital.
Yeah,
we're at I don't know what the clock metaphor was, but I thought it was pretty compelling when I heard it.
Yeah. No, we're in the zone. Okay. Again, we don't know. Yeah, exactly. So if 6 o'clock is the bottom of the market, and 12 is the top of the market, you don't, as much as you'd like to look at the clock. Yeah. We don't have a clock, so you want to be buying ideally between kind of 5 and 7 o'clock is ideal. You don't get hung up that you bought at 5. Yeah. You don't get hung up that you bought at 7. You don't get mad that you missed 6. Yeah. But you certainly, there's no way to be buying at 6 if you start buying at 7. Yeah. Because then you're most likely, because you don't get a deal then you don't buy until 8 or 9 p.m. And not that the deals are bad, you're still before 9 p.m. So maybe it's like it's a good deal, but after 9 p.m. they start being a little more marginal, I'd say. So our belief is we are in the zone where it's time to deploy and
Yeah, I think that definitely makes sense. There's like, you have to anticipate that things may go down a little bit, but it seems like the general assessment is that things are evening out a lot, and I have a feeling that this increased sales activity is going to raise prices, or at least staunch whatever bleeding was happening. And I also want to note that some of these valuations that are popping up, there are maybe 3 months ago where the valuation was negotiated between the buyer and the seller. So there's a little bit of a lagging data. By the time that
huge
you think,
lag,
by the time
actual
you think
prices,
by the time you think you're at 6 o'clock, maybe it was that 3 months ago. But
yeah, no,
I mean, look in the future.
A deal that we, this deal we've got going that we put under contract, early in February, we negotiated the price in January, mid-January. We're going to close by May.
Yeah, and
before May, April.
And 15th. Who's to say which when this becomes a part of history and a part of CoStar's calculations, are they going to put that valuation in May? Or do they put the valuation at the moment that it was negotiating in January?
They don't know anything They don't know anything about the negotiation. What do they know?
I know. Well, yeah. So
they don't even get the price right most of the time.
So in that way, yeah. Well, that's what I thought you were going for. It's like, I mean, but we use their data.
But data we have. That's why we make comments on it.
But my point is the same thing for both CoStar and for everyone's. Like, there's a little bit of ambiguity because there is a delay between the negotiation and the final closing of the transaction that makes it difficult and makes a significant lag for if you're trying to predict where prices are going to go.
Yeah. No, but this is the time. This is the time where the right moves, the smart moves, could be very profitable, and you're going to look back and glad that you made moves when others were still in fear, and while others are retreating, you're charging in, full force.
It could be really exciting, when it comes to the summer. And I'm not saying that this is going to happen, but I could see a little bit of froth coming up as rent growth comes in during late spring and early summer, and people are like, well, oh wow, I thought that the supply was going to crush things. Things are looking good if I project these numbers, and that may be too late.
No, I think we'll be back to 5-ish caps before you know it. Yeah. Not that there aren't some 5-ish sort of caps being still done or considered today, but most deals are closer to 6-ish. There's a lot of ish right now. I think we'll be closer to 5-ish. I don't want to say even before the end of the year. Over the next 2 years or so. It's so hard to predict. You don't. It's people are here for the commentary, so I don't mind throwing some numbers out. Because again, one of the reasons why I like doing this show, and Matt, it's been cool as we're in the middle of this fundraise. And I just wanted to mention this right now is that we've actually had when we started doing this, we just thought it would be fun. We started with a newsletter, like keep people up to date. Good to review what's going on in the market. Might as well let's record the conversations. We're already having these conversations. Let's record them. Let's throw it into a podcast. Why not? It's so cool having people reach out to us and invest with us after hearing, just from watching the podcast, and people who were like, I started investing in multifamily. I wanted to learn more about what I had invested in, so I started watching the Gray Report to understand what's going on in the market, and then eventually reaching out to us and partnering with us, which is really, really, really cool.
Well, it is really complimentary, because one of the things that I envisioned when we started this is at the very least, maybe we get 5 viewers or whatever, but we can show an investors, like, you want to know how we think, the kind of decisions that get made, and like, this is our thoughts laid out here. You've got 5, 10, 100 hours so far, even more that you can go over.
It's the opposite. It's not, we're not Joe Biden. Not
we're not anywhere yet.
A press conference. I'm not going to make a comparison to FDR, but the fireside chats. It's important, I think, to keep the communication up. And if you're evaluating a sponsor, you want to know where their head's at over time, and go back and see what Matt and I were talking about during the pandemic, during 2020, during 21, during 22, during the crazy years, during this whole period of time. See where our head was at, and see if we were right or wrong. We were certainly not right on everything, Matt. Wrong on some big things, but we got I think a lot of the really big things pretty close to right, and we're certainly there's a lot of data. We should put this on chart at some point of like when we cover a topic, and then all of a sudden it gets picked up. You know, a couple weeks later, it's pretty interesting. So
I've stopped being surprised when that happens, and now I'm like, well, is this just what everyone talks about? No. I'm coming back.
I think we're just a little bit closer to the source before it kind of trickles up to the mainstream media. I think it's more of what it is, or I don't know, maybe they're just using the Gray Report for all their leads. I definitely, a couple of the last few Fed press conferences, I'm like, there's some language in there. Are they borrowing from the report? I don't know.
That's true. I think so. I'll find his email.
I think so. I mean, even Janet Yellen. Anyway, we like to have fun. Okay, well, thanks for being here. Make sure you subscribe to the Gray Capital YouTube channel. You're going to get all the updates. We do have a live deal going in Gray Capital. So if you are a accredited investor, only if you're a accredited investor. If you're not accredited, we love that you're watching the podcast. We'd love that we wish that we could offer you an investment. But the SEC, which is a horrible organization, does not let us do that. I don't think the SEC watches it. The SEC, it's an organization of fine individuals, well-meaning individuals with. Anyway, so but you have to be an accredited investor, unfortunately, because of the government. But if you are accredited, we'd love to talk to you about this really interesting multifamily opportunity. It's a value-add deal in Evansville, Indiana. We're super psyched. Yeah. We're jonesed about it.
For real.
We're hyped up.
There are little travails that you will experience.
We're not going to use travails in any of our marketing.
Yes, we are not.
Matt, what does travails mean?
Troubles.
Yeah, I mean
troubles you have on your journey. I think
it's not a word I use a lot.
Yeah, trials, tribulations, travails.
Trials. I mean, like in the context, like I knew what it meant, but like. Yeah. You're supposed to write for like, the seventh grade education, or
probably a ChatGPT glitch, maybe.
Probably. Okay. So hop on over to graycapitalllc.com, subscribe to the newsletter, and hit us up, have a meeting with us. We'd love to talk to you.
Comment if you want to.
Yeah, comment. Tell us. Matt has been accused of being OCD.
I think it's because I fidget. Maybe
you fidget. You get
excited.
You take a lot of good notes too, which is good, which is very helpful.
Yeah.
I think I certainly am long-winded and talk too much, and people are like, this should be 30 minutes, 45 minutes. We're at an hour and 20 minutes. What the hell are you guys thinking? And we're just doing our thing, and don't watch all of it. Yeah, it's cool.
I don't want to say there's no accounting for taste, but I think we've also cultivated a very good audience of people that I agree with.
I think our audience, Matt, is smart, attractive.
That's right.
And earning some good money.
Yeah.
And did I say attractive?
Oh yeah, I'm very optimistic.
Very. Okay. Everything appropriate that you would expect from a finance publication. Thanks for watching. We'll catch you next time.